Welcome back to another episode of the Invest Like a Billionaire podcast. I am your co-host, Ben Frazier, joined by fellow co-host Bob Frazier. If you've invested in real estate for the past couple of years, even recently, and you've heard this term capital calls, you're wondering, what is that? Should I do this? Well, we have some news for you. If you invest in real estate and expect to for a period of time, you will be asked for capital calls. It's just kind of part of the deal. But the question is this worth doing? Am I putting good money after bad? Or is this something that really will protect my capital and help me not lose capital? So stay tuned. We're going to dive into all the things you do to understand if this is something worth doing. This is the Invest Like a Billionaire podcast, where we uncover the alternative investments and strategies that billionaires use to grow wealth. The tools and tactics you'll learn from this podcast will make you a better investor and help you build legacy wealth. Join us as we dive into the world of alternative investments, uncover strategies of the ultra wealthy, discuss economics, and interview successful investors. Looking for passive investments done for you? With Aspen Funds, we help accredited investors that are looking for higher yields and diversification from the stock market. As a passive investor, we do all the work for you, making sure your money is working hard for you in alternative investments. In fact, our team invests alongside you in every deal, so our interests are aligned. We focus on macro-driven alternative investments, so your portfolio is best positioned for this economic environment. Get started and download your free economic report today. So, Bob, what is a capital call? Give us a real quick just breakdown of what that means. People hear this term, it's kind of floating around, and people might not know what that means.
A capital call is when a capital guy comes knocking on your door and says, write me a check. So you've made a passive investment. So maybe you put $100,000 into an apartment deal, multifamily deal or something. And the operators come back and say, something went wrong, we've got an issue, and we need a little more money. And so because you put in money once, you got to put money in again. And of course, there's rarely actually an obligation to put in money, so you don't have to. But the issue is, a lot of deals that if there's not additional capital coming in, you could lose the entire investment. So if I put 100,000 in, I could lose the entire 100,000. If you're in the equities part of the stack, you're the last capital to get paid. You get the most bang for your buck if it works, but it's also the riskiest if it doesn't. And so, it's really protective capital a lot of ways. So let's say, rates went up, they got a delay, they're rehabbing this apartment complex, so they had a bunch of delays or something for some reason, and all of a sudden now they just don't have enough money to finish the rehab, and because it went longer, they had more interest payments, so now they're coming and saying, hey, we need another $30,000 from you. So that's a capital call.
That's a capital call. And so to your point, it's not usually a requirement, right? So it's a sponsor will come to you and say, hey, we need X amount of dollars spread across all of our, limited partner investors. This is how much pro rata we need everyone to contribute. And then usually it's qualified by, if you don't contribute, you will at a minimum be diluted, right, in your equity, because they're bringing more equity to, make it a bigger pie from the initial pie. And so you will be diluted, meaning your ownership of that equity goes down if you don't contribute. But even...
And let me just make a point. Yeah. So some deals are called cram down deals, and that's where they are very dilutional. So the truth is that new money is always worth more than yesterday's money.
Yeah.
And so, maybe they raised $10 million to buy this apartment complex and they only need 2 more. And maybe you got for $10 million, you got, a certain percentage of the deal, but the $2 million is a lot more valuable money. And so those guys can come in and say, I want a bigger percentage of the deal. And so you do what's called a cram down of existing investors. Now, I haven't seen any real estate deals that are doing cram downs, but it's very common in capital calls to do cram downs. And that's where it is very dilutional. You could literally be, really diluted, heavily diluted. So it's very protective. But it opens up the operator to lawsuits, investor lawsuits.
Sure. Yeah. So it's
maybe not as common in real estate, but it is a possibility. And if a sponsor gets desperate enough, they have to make it attractive enough for the new equity coming in, right? So, but to your last point, if they don't meet this capital call, if they don't get the funding requirement, it's possible that the deal doesn't make it, right? And then at that point, since you are common equity, you are the last person paid in the line of, you know, capital on the capital stack, you have the highest risk of loss. And so it's really, really important right now, because we're kind of entering into the beginning parts of a lot of deals that are struggling. A lot of loan maturities are hitting over the next 18 to 24 months. Interest rates are, 500 basis points higher than when most of these deals were initially underwritten, and has completely changed the landscape. And so we want to come on and break down, like, what are the things you should be looking at?
Should you write a check or not?
Write a check.
So we're going to answer that question.
Yes. And it's interesting too, because part of the reason I had this idea to talk about this is I think investors are feeling this, right? They've been hearing it, and we've talked with a lot of investors even in the past few weeks that are just saying, hey, I just need to hold on to my cash. I'm trying to get as much liquidity as I can, because I was expecting a lot of capital calls in 2024. And so if you haven't been called yet and you've been investing in real estate, lucky you, but you might be getting some calls here pretty soon. So we're going to kind of break down some of the key things you want to look for. So kind of to set the framework, I think first you have to understand and ask the question of what happened, right? That's the first question you got to answer. And I think it can come down to a few broad categories. It's usually not, one or the other. It's probably a combination of both. But I would put the two big categories are mismanagement and missteps of the sponsor, and then things that they couldn't control in the economic and external environment that they're in that have impacted the deal and changed the deal from the initial underwriting, right? Because when a deal is initially underwritten, they're always building reserves in, they're always building some sensitivities and stress tests in. But we've had one of the biggest and fastest shifts in the commercial real estate market that we've seen in the past several decades. With the interest rates rising as fast as they have, it has completely changed the game on what credit looks like, what the getting new capital and new equity looks like, and just risk tolerance from banks, lenders, et cetera. And so you really have to understand, was this predominantly due to mismanagement of, the budget, the operations, things that could have been foreseen or at least could have been handled better, right? What's been the communication of the sponsor since the deal was started? Have they actually shown you everything has been going rosy? Hey, we're 2 years in this deal, we're going great. And then all of a sudden, out of nowhere, hey, we only have 3 months left. If we don't get this capital, deal's going to foreclosure, right? That's not a good sign, right? If it's kind of been swept under the rug, I think you want to see some transparent communication. But then also realizing, like, real estate is a business, on the active side of these sponsors. This is an active operating business that they are doing, and there's things that you can't foresee. There's plans that don't happen, and things that do happen you don't expect. And, we always do really good underwriting. I believe in all of our deals. We try and think through every option, stress every kind of conceivable thing we can think of. But at the end of the day, I know that I'm never going to hit 100% of my pro forma. It's just impossible because I can't predict the future.
It's all projections and all assumptions. We all have to make assumptions now. But we've seen a lot of underwriting out there, and we've seen very aggressive assumptions, right, in some of the underwriting. And you're going to get 20% returns, and here's all our assumptions. You're going to see super low cap rates. You're going to see this and that and the other. And it's all these assumptions. And, it's a real mistake. So it's hard for a novice to look at underwriting and figure out if it's aggressive or not. And so, we had to do another show on really, how to look at the assumptions underlying this underwriting. But a lot of times, as you point out, it's not the fault of the operator. But even if it is the fault of the operator, the question is, are they doing stuff that's right? I mean, I was just in a capital call, and these guys, they partnered with a pref equity company, and the pref equity company says, we have a new management company that we're starting. We'll give you the money on the condition that we can manage the property. So they agreed. Well, this property manager did a terrible job during COVID, not doing proper credit checks and letting all the wrong people in. Well, it just nuked the project, but they're doing everything right to fix the project. So there's just lots of missteps that can happen, especially when you got big complex deals like that, and lots of things where they're somebody really dropped the ball. The question is, do they have a plan going forward?
Right. And so I would say kind of first get the understanding of what happened, right? You want to have a good story that makes sense, right? Like what you just said, like that makes sense, right? And so I think in that scenario, they put a lot of tenants that shouldn't have been renting. They did terrible screening, and then COVID hit and they couldn't evict. So now they have just cash flow burn like crazy that they couldn't predict. And they are operationally getting the project back on track. So they've gone through all the eviction process. They've replenished new tenants that are paying, that are higher quality tenants. Occupancy is trending upward. So the first thing that I say you got to look at is look at the operational trend lines of the project, right? Because real estate, at the end of the day, it's location, 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 right? So if it's in a good area, if it's a good property in a good area, and you're starting to see positive trend lines. So the positive trend lines I would look at are you seeing, the gross potential rent, which is what's the market rent, in that submarket for similar type properties? Is that holding strong or growing, right? And then is the deal trending closer to that, right? From both a market rate standpoint for what you're actually charging on the units, and then also occupancy. Because a lot of times the break-even occupancy, depending on the leverage and the capital stack, is probably going to be somewhere in that 70 to 80% range. And so they're right in the bubble, right? So maybe it's 65%, but they're pre-leased to 70, which means they have new leases that have been signed but not yet moved in. And so you're seeing these positive trends toward the right direction. So that's something you really want to see. And then you want to understand too, the other kind of piece of this is to throw in just their interest rates, but you may not be aware, but the whole insurance market is completely in upheaval. We're seeing insurance renewals on a lot of properties, especially in the southeast, 100% increases year over year, double. We haven't seen these types of increases really ever on insurance. And so you're seeing all these surprises, right? Aside from just the interest rate, challenges. So understand what's going on the expense side as well. And then what's the path to cash flow, right? That's the key thing. If you can cash flow.
Two main things we want to look at. And these are two big questions you need to answer to get to your yes and your no. And that is, do they have a path to cash flow? We'll talk about that. And then the second is, do they have a path to clear the capital stack, to basically pay back all the lenders and investors? So path to cash flow. So what does that look like, Ben?
That's what I've just been saying. So you want to look at what's the trend line for your revenue, right? Because that's going to create the margin. If you can continue to grow revenue, whether that's through higher market rates and higher occupancy, those are your two real levers, right? And then you want to understand what's the expenses. Have they absorbed a lot of these new higher expenses? And that creates your net operating income. And what's that currently right now? And where does that kind of trend going over the past 3 months? And, where's kind of the next 3 months look like from a pre-lease standpoint, or just, getting new leases in. And so you want to kind of see the trend lines go in the right direction. And then you want to see that path to cash flow, because if you start getting the higher occupancy, you get your expenses under control, you get your market rates, then that cash flow number is hopefully not too far away, meaning the NOI, the net operating income on your property will be able to service all your debt and continue to keep the property afloat. Because if you can get to cash flow, you can ride through the storm, right? So that's really
and one of the biggest issues of cash flow, is occupancy, as you just said. Are the trend lines good? But then can the debt be serviced? And a lot of times they may be talking about bringing in new debt, right? And so can that debt be paid, right, out of cash flow? And still you want to know, can it get to cash flow positive? And you want to understand too, a lot of the lenders have a debt service covenant where you have to have a certain coverage ratio. And it's usually somewhere around 1.25, meaning that the property has to have enough cash flow to cover the debt service at 125% of the debt service. And so you want to do all that math and, and ask and really push on that. Now, a lot of times when people do capital calls, they will have a webinar, they will have a call, and they'll be available to ask questions. So these are the questions you need to ask: is show me the path to cash flow. Show me what this looks like. And, and it may not be clear, may not be a clear answer. One of the other deals I'm looking at, they're getting ready to do a capital call, and basically they need, because interest rates spiked and they're seeing a maturity in their bridge debt, they need $1 million just to put a rate cap in place for one more year. So it buys you 1 year. So then the question is, you got to ask, well, what does that 1 year buy you? What after 1 year? What if the rates don't go down? Is it the same story again? And the answer is probably yes, another capital call. And not good, right? Not good. So it's not always a clear-cut decision on the cash flow. When you have these big one-time expenses, you have to make assumptions on interest rates, and you have to make assumptions on insurance and on taxes, right? We see big tax raises recently, for some reason. So you got to make assumptions on all that.
Yeah. And I think that's a great point, right? A capital call should hopefully be a one-time thing, right? So the next kind of part of the questions you should be asking is, how much time does this buy you, right? And in this case, you just gave of the interest rate cap that they're buying for 1 more year, which basically limits the interest rate that they're paying on their debt service, and they're basically buying, a swap, so that they can, keep a fixed rate at a lower rate, continue to pay the debt service at that lower rate versus the readjusted higher rates. But they're very expensive right now for obvious reasons, because interest rates have gone up so much. And if that capital call only buys you enough time for 1 year, you better see really strong performance within a few months to service not only the current debt service, but adjustment in the interest rates after a year. And if you don't, then you should ask the question, what happens if we're a year from now, we've got a little bit of improvement? Are you going to do another capital call, right? Because
another capital call generally is not an option. Generally I've never seen a second capital call work, ever. Yeah. Generally you got one shot, right? You got one shot to convince investors. And I've seen a lot of mistakes where they say, okay, we need X bucks. They divide it up amongst all their LPs, and then they get only about 50% of the people respond. Well, they only raised half of their required number. You have to get so you get, it's all or nothing with these capital calls. If you need $3 million, we need $3 million, and that $1.5 million isn't going to do it. So a second capital call is not going to work. So you want to really look hard at, does this capital call, will it get them over the hump cash flow wise?
Yeah, 100%. And I think the other kind of main thing we'll look at, you said earlier, is how do they clear the capital stack? And so what we mean by that
explain that.
Yeah, so we've talked about capital stack before, and it's very, very important right now, if you're doing a capital call, to understand, what does the current capital stack look like, right? Is it, a bridge debt lender with a short maturity with some preferred equity on top that's hard pay, which means they actually have takeover rights if they're not being paid current. And then you're kind of the last, sliver here.
Can we dive in a little bit deeper on that and talk about hard pay, soft pay, and the capital stack? So just because we want to be, really explain this to people, that this may be a new concept. So capital stack starts with the senior lender. Yeah. And typically that's a bank or bridge lender. And that's the senior mortgage. And they have a lien on the property. And guess what? They get money. They get paid off 100% before anybody gets anything else, right? So that's called priority. And they have the top priority. So every bit of cash coming out, they have priority. Then the second part of the stack is a mezz debt, if there is any. Now that's uncommon, but it would be a second lien in essence. And they get paid the next money after the senior lender gets paid off. Then they get the next money and they get paid off 100% before anybody else gets a dime. And then the next, and those are fairly simple. People understand those are mortgages, right? Then is preferred equity, pref equity. And this is where this is equity, but they get paid off a lot of times 100% before common equity gets in. And then common equity is what you and I typically invest in as a limited partner. So we get paid last. Okay, so talk about pref equity. And we'll talk about bridge first. Talk about bridge, the nuances of bridge, and then talk about pref equity.
Yeah. So bridge is you're referring to as bridge debt, which is, generally senior debt and generally non-bank debt. So this was very common kind of in the 2020, 21 kind of era where a lot of deals were done at pretty high valuations. And there's a lot of attraction for doing this as a sponsor. We've talked about this in the past, but they generally give very high leverage, 80% on purchase price plus 100% on renovations.
So if you're doing a deal and you're get 80% bridge, that means you only have to raise 20%. So it's a good deal, right?
Good deal. It's non-recourse to the sponsors, meaning there's no personal guarantees except for fraud. And so, pretty attractive, really high leverage. I don't have to raise much equity. I don't have any personal guarantees on the line. So it's, it was very attractive. But the issue was they're always floating rate. They're floating rate notes unless you bought an interest rate cap. And so,
and that's usually
3 years,
usually a max of 3 years. And so what's happening, a lot of the deals are now maturing. These bridge debt and the floating rates are spiking up.
100%. So that's where a lot of these deals were initial 3-year terms. They're starting to hit their maturities. And we've talked about this in past episodes, but at least 25% or more from what we're seeing so far will not qualify for refinance, right? So they haven't hit the operational targets in NOI necessary to achieve the valuations to get new debt that would pay off their current debt. So that's where a lot of deals are at. And so preferred equity, the preferred equity generally sits on top of that and increases your effective leverage even more, right? So they come in and, take anywhere between, 70 to 80% or kind of that 75
I've seen it from 80 to 90. So you only raise 10% common equity and you're 90% leveraged. I mean, now this is an example of very risky underwriting, but the 25% IRRs, that's if everything goes great, but anyhow, so
right.
Back to pref.
So back to pref. I mean, there's generally kind of two common types of pref: hard pay, soft pay. So preferred equity generally is structured where they have a current pay portion that they are expected to get on an ongoing basis. So
what does that
have, say, it's a preferred return, or it's kind of a almost like an interest rate where they have to pay that every month.
Okay, so it's cash. So the property has to pay cash, a portion of it.
And so that's usually somewhere in the 6 to 8% range, paid out every month, just like you pay your senior lender. And then they have a back end fee, which is somewhere between, say, 6 and 8%, that gets paid out, not in cash, but once the property sells or refinances and they get paid off, that accrues every year. So it's expensive, but it can effectively increase your leverage. It can help increase returns for the equity investors. But the kind of big distinctions are hard pay versus soft pay. So a hard pay for equity group, if they are not being paid on their current portion, that has to be paid out in cash every month, that 6 to 8%, they have the rights generally to fire the manager, which is the sponsor, and take over the deal and make decisions on the strategic
or force a sale.
Now,
if they force a sale, they don't really care about the common equity on top of them. They just want to get paid off. So anybody down the capital stack who forces a sale generally will mean a 100% wipeout for the equity guys. So if you get the senior lender starts or forecloses, the junior lender forecloses, or the pref equity guy take over a deal to force a sale, all those cases you will see the equity guys, the common equity guys, get wiped out.
Yeah. So that's the capital stack. And I think going back to the initial question is, how do they clear the capital stack? And what that means is, what's the path? They got the path to cash flow, but then what's the path to get fully stabilized, meaning they kind of hit higher occupancy, they're hitting their projections on their net operating income. And then if they have a bridge debt lender that is, their note is maturing in a year, they're going to have to either refinance or sell. And based on the valuations, based on the current net operating income, what are the assumptions that they're making to refinance at? Right? What's the interest rates that they're using in their analysis? What's the valuation that they're using in their analysis? And what you want to do, so path to cash flows first, because that saves a property from getting behind in payments and having foreclosure. But if there's not enough operating income to support the value, and the values have gone down a little bit right now, right? Because interest rates are higher. Well, then they're not going to be able to clear the capital stack, and with their refinance or a sale, and that impacts you as an equity holder, where you're not going to be able to. They're going to have to continue to figure out the capital stack with that gap that they have, right? We talked about it. So, those are kind of the real big things.
How does a novice figure that out? If the cap rates are real and the assumptions on the refinancing, the clearing the capital stack are accurate.
Yeah, those get a little more technical. The kind of simple thing I'll say, here's a simple kind of heuristic to use, because most deals will refinance into agency loans. So this is Fannie Mae or Freddie Mac. These are agency, government-supported lenders that have generally more attractive financing than, other banks and bridge lenders. And they only generally lend on stabilized assets, right? So it's a perfect fit for kind of refinancing into more permanent financing. Their kind of, I'd say, primary thing they look at is debt service coverage ratio. And they want to see right now a 1.25x debt service coverage ratio. So what that means is they have enough net operating income, divided by their now new debt service from the Fannie or Freddie loan at a 1.25 ratio. So there has
125% coverage of the
125% coverage. So that's the simple one. So look at,
are those amortizing? Are those fully amortizing or interest?
No, they're usually interest only, but they will. The 125 is based on amortizing debt service.
Gotcha. So that means where they're paying interest and the principal portion as well. So you got to ask that. And then what are their LTV limits? Because that's another issue that properties are having.
Yeah, LTV is less of an issue because they'll generally go up to higher LTVs, but with current debt service at the interest rates they're at right now, inevitably the LTVs have to be a lot lower. That's usually the constraint is debt service because of interest rates being higher. So gotcha. Right now we're probably
really the main thing is
65%
coverage ratio and there you go.
And here's the last thing I'll say on capital stack, because we're kind of getting really in the weeds here, but a highly leveraged deal on the front end, let me say this, the higher the leverage from senior debt to mezz to pref and that kind of whole stack ahead of you as common equity, the more that is of the capital stack, the harder the plan everything is achieved. Everything gets harder because in this environment, credit has tightened, leverages are coming down, interest rates are higher, everything's more expensive. So the chance of success goes down, in my mind, exponentially the higher the leverage that you have. And so I think that's just a simple thing to understand is what was the initial underwriting and leverage? If it was 80%, 90%, combined, it's a very, very, in my mind, small chance that deal is going to survive.
Right. And let me say one final thing here. So getting back to our yes versus our no, yeah. I think your first approach should be, this is a yes looking for a no, right? Your default should be a yes, because you realize that if your answer is no, and if this doesn't work, you will get wiped probably. You're probably looking at, depending on the market and everything, but you're looking at probably losing 100% of your investment. So you should be saying, let me go and be protective about this unless there is really a reason why this is definitely good money after bad. This is not going to get me. This is a bridge to nowhere, right? This is a capital call that doesn't get me across the chasm, and then it shouldn't. But if it can get you across, you really should do the capital calls. And then smart investors always reserve a little bit for capital calls. I understand that even the best deals and the best operators have a deal sometimes that just goes a little haywire.
Right. So hopefully this was informative to you and helpful. And we're planning on doing a lot more of these kind of in this vein, because we know this is a really important issue for investors over the next few months. So feel free to write in questions, other things that maybe we can spend more time on. And we really appreciate you listening. Hopefully you got a lot of value to this. We appreciate your feedback, any reviews, sharing this with folks, and hopefully you tune in next time for another episode of our podcast. Thanks so much.